Good afternoon, and thanks for joining us for today's webinar, Construction Accounting and Industry Update. I'm Dan Sturm, partner and leader of the firm's construction practice with McKonly Asbury, along with Aaron Stagliano, principal, and Tim Showers, manager with McKonly Asbury. I'm also pleased to welcome back Gary Rispoli, partner and director of surety and construction risk at Construction Risk Partners. For those of you who don't know, McKonly Asbury is an accounting and business advisory services firm with offices in Camp Hill, Lancaster, and Bloomsburg, Pennsylvania. We provide a range of services to organizations across a variety of industries, as you can see on the screen, and we encourage you to visit our website to learn more. If you joined us on past webinars, welcome back. If you haven't, our monthly webinars feature various business topics to keep you updated on what's going on around us. Be sure to check out our website to catch past presentations as well as current information through our blog. If you have any questions for us during today's presentation, please submit them through the built-in questions function in the webinar control panel, and we will do our best to answer them during or after the webinar. For those of you that are looking to obtain CPE credit for today's webinar, please keep in mind that there will be 3 polling questions throughout today's presentation, and you'll need to answer all 3 of those questions to get your certificate via email a few weeks after the webinar. And with that, I'm going to turn the presentation over to Tim to introduce you to some questions on lease accounting.
All right, thank you, Dan, and thank you everyone for joining us this afternoon. So certainly from an accounting and reporting standpoint, the main event here for 2022 is the upcoming new leasing standard. So if you have a calendar year end for your fiscal reporting, this would have been effective for you 1/1/2022 and will thus be applicable to your 2022 year end reporting. At a high level, there are 3 key changes involved in the standard. The third change listed there, and especially the second change listed there, will be the items that are most time consuming and extensive in terms of requiring preparation in advance of implementation. So the key change there, the second one, is the fact that operating leases are headed to the balance sheet for the first time in terms of requiring asset recognition and a related liability recognition. And the key takeaway that we've seen from those who have adopted thus far is that there's a natural tendency to take the standard a little too lightly. So as you prepare, just want to make sure that you give it the time and attention that it deserves, so that you're ready when it comes time for 2022 reporting, and that there aren't any surprises at that point. So if we head to the next slide, in terms of key planning considerations that you should be thinking about as you prepare for your 2022 annual reporting, you really want to start by gaining the full visibility on your leases. So you want to inventory your leases just to make sure that you have a good handle on everything that's out there, so that you can analyze everything as a whole. You also, as you take control of that inventory and gain knowledge of the full population, similar to purchased property, plant, and equipment, you also want to categorize your leases in an organized way. You want to categorize them, and then as you analyze them, key things to be looking for are things like making sure you have a handle on proper lease terms in terms of duration, identify any optional extensions that might come into play down the line, and then also elements such as variable or escalating payments, because these are the types of things that will drive certain judgments that you have to make when it comes to time to measure your operating lease assets and liabilities. So one of the key things that we wanted to do today, as we head to the next slide here, is just go through rapid fire in terms of frequently asked questions that we're getting from our clients as they've begun to prepare for this or have implemented this. So as we head down the list here, the first 2 items there can very much go hand in hand for a contractor in terms of, a lot of times it's very common for a contractor to be leasing equipment on a short-term basis for use in ongoing projects. So let's say that you have some leases that you're going month to month on for use on your projects. A common question can be, how do I handle these? Do I have to handle these any different under the new standard as compared to the old one? The key aspect here is just if it's truly a month-to-month lease that we're talking about, where you can literally exit that contract at 30 days notice or short notice without any significant penalty. You have alternatives open to you in terms of different equipment you can use in place of what you're under lease for there. Then the answer is no, there's no change. So you just have to continue to worry about recording things on the expense side. But because there truly is no long-term commitment that you're legally tied to there, in terms of month to month, you do not have to worry about recognizing an asset and liability in those types of situations. So that would be the case whether it's month to month or whether you have some sort of other short-term lease involved there, whether as in a term that's 12 months or less, in which case the defined term is short-term in nature. It's only so unless you don't have to recognize assets and liabilities associated with those. It would just be if your defined term that you're locked into exceeds that 12-month time frame. That's when you would want to be putting those on the balance sheet. Third option, the third frequently asked question there specifically often comes into play when we're talking property leases. And it comes a key judgment that you'll have to make when measuring the lease asset and liability associated with the property lease will come into play if your property lease has optional extensions. So just to throw out a common scenario, perhaps your building's headquarters has a defined initial term of 10 years, and then you have an optional extension for 5 and perhaps a second optional extension for 5. The key things to think about when you're asking, well, do I need to include those optional extensions when I'm measuring my future lease payments, and thus do I need to include those when I'm applying my discount rate to those future lease payments and thus measuring my assets and liabilities? You have to make the determination of what's most likely to happen. So is it reasonably certain that down the line we are going to exercise that lease option or not? And so you have to think about, you're encouraged to think about different factors that might incentivize you to exercise that option or not, or disincentivize you to exercise that option. So a common thing that might happen in our example where we're going 10, 5, and 5 is if you've invested in some leasehold improvements that are 15 years in terms of their useful life, perhaps you'll say, okay, we certainly have an incentive to stay here for that first option, exercise that first option, but we can't currently say that there's an incentive to exercise the second option to the point where it's reasonably certain to do so. So perhaps in that scenario, you'd come to the conclusion that you will take 15 years of payments when you're measuring your assets and liabilities. So you're going to say it's reasonably certain that we'll exercise that first option, but we're not going to include that second option when we're making that measurement.
And Tim, I think the key point of that is that there's obviously going to be some kind of judgment involved with some of these, especially documentation of kind of management's assessment, how they reach those conclusions, especially if it can be a little subjective, I think is really critical, especially if you're on the webinar and you're going through an audit. I think speaking from an audit perspective, we're going to look for that documentation. So I don't want to sit here and say we're necessarily going to question your judgment, but we're going to look at the approach you took to make that determination. So if things aren't clear or it's a little bit subjective, make sure you're maintaining that documentation for your decisions.
Yep, absolutely. That's a great point, Dan. Yeah, for this or any matter of judgment that comes about as a result of implementing the standard, the key part there is just documenting the reasonable basis that led you to the conclusion you did. Right, and then the last one on this slide that we wanted to cover here is the things to think about when you're setting a lease capitalization threshold when you're implementing this. So A good rule of thumb when you're thinking about this would certainly be to think about your existing capitalization threshold for your purchase PP&E. That's certainly at least a good starting point for you. And usually using that is usually a safe way to go. As you think about what to set from a practical standpoint, it's key just to maintain visibility to ensure that excluding those leases from capitalization would not be material to your financial statements, either at the individual lease level or in aggregate. So this is one of those aspects where it's really important, like we mentioned before, that you really want to get a good handle on the full lease population that you have, so you can see the big picture. Right, and then just a few other.
Sorry, we keep getting back to, I think, basically that inventory of the leases. I mean, I think of all things to kind of implement the standard, and you said it to start off your presentation, it's really all about that inventory, making sure you're taking accurate inventory and identifying everything. And not only identifying everything, but you might have a lease, but then maybe the documentation is 3, 4, 5 years old. Then it's a matter of finding documentation. So it can be a fairly time-consuming process just to get off the ground and running.
Yep, absolutely. So definitely want upfront. I think this is one of the areas where it was underestimated for those that have gone already in terms of implementing this. Just the time, you really want to give that the time it deserves, because it will help you when it comes time to when you go to issue your financial statements, when it comes time to prepare for that after year end. Great. So then just a few other ones that we wanted to cover here this afternoon in terms of frequently asked questions. Another common question that arises is regarding software licenses and whether those qualify for leases under the new leasing standard. So the short answer here is most likely not. In fact, the ASC 842, the new leasing standard, specifically carves out software itself from being a part of the new standard. So that's explicitly called out and left to existing guidance, and noted that perhaps there will be some future guidance that provides further clarification on software licenses as technology continues to evolve. One thing just to note here, when it comes to your software licenses, is just ensure that there isn't any embedded lease in your license arrangement. And by embedded lease, what we mean is there's any type of situation where you're leasing a software, but also as a result of that arrangement, you have the right to use hardware perhaps related to that, but you don't own. It could come into play where that hardware or other aspect of that license could qualify as an embedded lease, and that particular aspect would need to be considered for capitalization. So in this instance, remember, the key thing here is no, the software itself will not be considered a lease, but just be on the lookout for those rare instances where perhaps there's an embedded lease as part of that arrangement. Secondly, on this slide here, another common question. Now, if your organization is an organization that does not issue financial statements based on GAAP reporting, perhaps you use cash basis or income tax basis, you might be wondering, well, does this new standard apply to my organization? So the short answer here is it won't affect the face of the financial statements. As in, if you're income tax basis or cash basis, you won't have to worry about measuring assets and liabilities associated with your operating leases. So you're off the hook there. However, there are some disclosure aspects, some additional disclosure aspects that you will need to consider when it comes to year-end reporting. And so here, so no impact to the face of the financials, so no impact to balance sheet or income statement, but there are some disclosure considerations that you'll be required to think about when it comes to your footnotes. Another common scenario here as we move to the third item here, a lot of organizations have ongoing lease arrangements with related parties. And so there's some interesting aspects, some important aspects to consider when it comes to these arrangements. And the key here that we would encourage is to focus in on the legally enforceable rights and obligations under those arrangements. So that's the lens that the standard really encourages organizations to approach this with. So if you're thinking about a related party arrangement, this might be an important opportunity to revisit those existing agreements and make sure that the language of those agreements is consistent with what you intended. So in a situation like this, if you intend for the arrangement to be month to month, where perhaps you're leasing equipment between related parties, and the idea there is that you want it to be month to month, status quo accounting wise, where you don't have to worry about capitalizing your operating leases between those entities. Just make sure that you've updated the documentation, the language is. This goes back to related to Dan's point earlier about documentation. Just make sure that it's clear there that this is a month-to-month lease. Either party can voluntarily exit without significant penalty, and that way it's clear, yes, and there's no ambiguity there in terms of whether you would need to put that on the balance sheet or not. Right, and then lastly, a key consideration here, just overall in terms of how to approach this new standard, is at what volume of leases when is it worthwhile to consider leveraging a lease software rather than to go with the Excel route or the manual route? Really, two key considerations here. One is the volume of your leases, and then the other one is the complexity of your lease arrangements. So volume wise, across the board, regardless of complexity, you're in a situation where you have, in our experience, if you're in a situation where you have 10 or more, just from a volume standpoint, 10 or more leases, tracking those, we would recommend that you leverage a lease software in some way for those. However, if you have more complex leases, perhaps some property leases where you're dealing with escalating payments and optional extensions and lease incentive arrangements and things like that. Even if you have a handful of leases, so even if you're talking in the 3 to 5 range, perhaps, we would encourage that you leverage software in those cases as well, either directly on your own or indirectly through a third party, at least in the first year. There are so many moving pieces as you plan to implement this, just in terms of bringing your initial assets and liabilities associated with operating leases onto the balance sheet, that it can be easy if you're trying to manually do it, and you can get 99% of the inputs right, but and miss 1%, and that could make a huge difference in terms of driving an adjustment. And then not only that, additionally, lease software, in most cases, a good lease software will provide you everything that you need to meet the additional disclosure requirements. So again, volume of leases is important, but also even if you have just a few but they're complex leases, it's definitely worthwhile. And we would encourage you to consider leveraging a lease software.
Hey, Tim, I think one other factor to add to that mix of not only complexity and volume, but we just recently had a conversation with one entity that they may have a couple leases right now, but they have a lot of intentions for acquisitions and growth, and kind of more forward looking of, hey, maybe Excel will work for the next year, but do we want to start with Excel and try to develop some probably fairly complex formulas and make sure everything's accounted for right? Or do we just want to start with a software product out of the gate that's going to let us grow into where we see the company going? So I think there's that other component as well, as where do you see yourself in 5 years? And it might make some level of sense to start with that software early.
Yep, absolutely. So there can be a large benefit when you're thinking cost benefit and thinking long term in terms of taking the burden off of your team, given everything that's already on them. In this environment, it can really pay off when you think things through that framework as well. Right, so that'll bring us to our first polling question of the day. CPE wise, this will be very important, so make sure you get your answers in for this one. And the question is, what solution are you planning to use to implement ASC 842? So a few different options there. Will you go the manual route through Excel? You're gonna look to get a direct license for a lease software. You're going to look to maybe go the indirect route and leverage a third party who perhaps has their own lease software and consult them and have them help you through the calculations. Perhaps you're still in that decision mode at this point, or perhaps you've done review and said you noticed that you don't have any leases or very few leases.
Yeah, and it's interesting as we see these results come through, a good chunk of the responses are not sure yet. And I think as we've navigated through this with both clients and prospects at this point, I think we've probably met quite a few folks that intended to start out using Excel. And I can say on behalf of McKonly Asbury, we determined early on that we would use a software product to serve our clients, whether that's one lease or 5 leases. We kind of felt like developing that Excel model might be a little too complex, too many opportunities for error, which I think Tim has actually observed on one client that had 1 or 2 leases, and he, after running it through the software, kind of identified a couple things. But again, I think each situation is unique. I think most of the conversations we're having with our clients is if you purely want journal entries and year-end disclosures, by all means, we can help you with that. We acquired our own software license to run that for you. But software packages like Simplease are so robust. They do so many more things beyond just give you the accounting. They allow you to have a database of all your leases, your documents, flags expiration dates. So once you start getting up 10 plus leases, there's a lot of tools that the packages offer that provide a lot of value to you as running a business to track your leases and account for them. And to Tim's point earlier, take a ton of burden off your team to try to develop models that somebody doesn't delete cells and formulas and things like that.
So important considerations from a planning standpoint as you go to prepare for this. So at this point, I'm going to turn it over to Aaron to talk tax.
Great. Thank you, Tim. Appreciate it. I am going to talk about a few tax credits that are not generally specific for contractors, but certainly relevant in the construction industry. So I'm going to hit briefly on 3. Just want you to think about them and see if they might be applicable to your organization. And if so, are you having that conversation with your tax preparer? First one is the research and development tax credit. Here again, if you are doing research and development type activities within your company, there's a good chance you may be applicable for this credit. The credit is usually equal to about 6 to 12% of those qualifying expenses. And I would say my best guidance would be don't just assume it does not apply to your organization. If your company designs, engineers, or constructs something that hasn't been previously attempted, you often have qualifying research and development activities. If you have engineers on staff, that is a huge indication that a lot of what your activities consist of likely involve some sort of design element that would qualify under the tax code. The credit can be very lucrative. It's dollar for dollar savings to reduce your tax liability. You can go back to previous years and do amendments if you find that you had the activities, but you didn't take the credit in past years. And the credits are available at both federal and state level. So what are some examples of qualifying research and development activities? It's pretty broad, but developing and improving construction equipment, designing HVAC systems, if your team is actually doing the design, if you're designing electrical systems, if you're using building information modeling or preparing structure and facility design for constructability, or basically doing anything innovative for the first time, doing something that nobody else is doing, or building a structure from the ground up, designing it in-house, using your employees and your resources and your subcontractors to advance some sort of new area there's a great chance that you may qualify for this credit. So we invite you to certainly open that conversation up if you think you may qualify. The next credit I want to hit is the employee retention tax credit. And if you follow our blog, you know we've posted on many things on this credit. Potentially, it is a very lucrative tax credit. We've had clients that have very big credits. So if you have not thought about this credit, or if you thought about it and said, you know what, I don't think we qualify, we're asking everybody to take a second look to really dig into the details and see if you qualify. Potentially, this credit is equal to $5,000 per employee for 2020 and up to $21,000 for 2021. So how many employees do you have times this potential $21,000 per employee for 21? You can do the math. It's potentially a very big credit. This is potentially it is eligible even if you've received a PPP loan. So that is no longer a disqualifying factor. And it's if you wanted to claim this credit, it would be on your form 941. If you've already filed your 941s for 2021, which I hope you have, the credit can still be claimed by going back and amending those forms. So 3-year statute of limitations on amending 941s. So if you haven't thought about this credit, I would invite you to take a second look, and I'll give you some details on the next slide. Here's what you have to do to be eligible for this credit. In 2020, were any of your gross receipts reduced by 50% when compared to the same quarter of 2019? And for 2021, the threshold was increased to only a 20% reduction in gross receipts during any quarter when compared to 2019. So as construction contractors, you usually have very volatile revenues. So you can't look at your revenues or your gross receipts on a year-over-year basis and say, you know what, 2021 was greater than 2020, 2020 was greater than 19, I don't qualify. You have to look at it on a quarter-by-quarter basis. And finally, we're just going to talk about fuels tax credits. This is a very easy credit to apply for. If you're buying clear fuel, undyed fuel, but using it for off-road purposes, there's a very easy form that you fill when you file your taxes that would get you basically a refund of your federal fuels taxes for using undyed fuel off-road. So if you're fueling your off-road heavy equipment, if you're fueling generators, forklifts, anything off-road with clear fuel, which has already been taxed, basically all you have to do is keep an accounting over how much clear fuel you've purchased but used for off-road purposes, and get that information to your tax preparer, and they will be able to fill out form 4136 based on that information and refund all of those federal fuels taxes as part of the income tax preparation.
No, and I think, Aaron, with each of these, and I know we're heading up on a polling question here, but I think with each of these, I don't know that there's anything necessarily new. Like, we're not talking something that just came out in the past 3 or 4 months. All of these have been around for some time. The fuel tax credits, the employee retention credit, while probably the newest on the list, we're still seeing opportunities as recent as I'd say last week, the past couple of weeks of folks that give us a call, and we ask some basic questions that haven't taken advantage of some of these opportunities. So the opportunities are there. It's making sure you take the time if you're not sure, going back and doing so, especially on that retention credit. We just saw a business get a couple $1 million credit, I think almost $3 million a couple weeks ago. So it's definitely worth taking a look. So if you're not sure, work with your service provider to make sure you're looking.
Exactly, completely agree. And with that, I think we'll roll into the polling question, which is along those lines of Dan's comments. Have you performed an analysis or used a service provider to determine eligibility for the employee retention tax credit? Or have you done the back of the napkin calculation and said, nope, don't qualify, on to the next project?
No, and some of the gross receipts calculation for the ERC is fairly straightforward, the 80% and the 50% you were talking about. But the business closure and suspension can get interesting if you read the IRS guidance, because it's not simply your business that may have been closed, but maybe you had key suppliers that prevented you from doing your business. So you can get into some tricky things like that. So if you, at some point, especially during the peak of the shutdowns, if you experienced any of that, make sure you're bringing it up to folks, because there might be still an opportunity, even if the gross receipts calculation isn't working out in your favor. And it looks like a good portion of folks have already been through the analysis, but we're still showing about 35%, another 7% that are either knows or unsure. So I would definitely take advantage of looking into that while the opportunity is still there.
Great.
And I think with that, and I don't want to steal too much of Gary's time, because I think we're going to overlap a little bit here, but I think what we want to do and what we've done in past presentations, not necessarily observations just on a global scale, but observations that we've seen directly with our clients and folks we've come in contact with. And I don't think any of the 4 bullet points up on your screen are going to be of any surprise to you. It's things we've been talking about at least the past 3 to 6 months, some longer, especially that first point, employee retention and engagement. So a couple opportunities that we wanted to put out there for you, just things we're seeing, what maybe our clients have done, what things we've learned to share with you. So retention and engagement. I think one of the biggest opportunities everyone on this call can take advantage of is just making sure you're creating training opportunities and growth opportunities within your organization. I think we can definitely see some consistency with our clients that have been able to retain the most people. They have growth opportunities, and the people feel. We have a few clients that have like in-house quote unquote universities. I think those things go a long way. I think going with outside trainers, even bringing in like a Dale Carnegie that we work with quite often, to bring them in for management and sales training, just creating those opportunities internally for your folks to grow, not just simply giving salary and merit increases. Discuss those opportunities regularly, just making sure people are aware that there are opportunities for growth. They can develop new skills, new techniques, how to do things. Mentorship programs go a long way. We talk about all those things inside McKonly and Asbury as well, as making sure that your internal folks have mentors and people to speak with. Compensation, briefly on this, I think everyone knows compensation has increased. I think what we're starting to see more of now is a global look at compensation. So see companies with great 401k match programs and things like that. Well, I think there's an opportunity where that 401k match, great benefit. I think we'd all probably agree with that. I don't know if it always keeps people employed. Maybe there's an opportunity to redeploy some of that money, maybe not increase compensation costs, but maybe lessen the match and look at other shorter term bonus programs, maybe a 2 to 5 year bonus program instead of an annual bonus, or forcing someone to wait till retirement to kind of get that income. So that 2 to 5 year would probably keep people retained a little bit more in some cases than just, hey, we have a great match, but you can't touch that money till you retire. So just a look at where your money's going from a compensation perspective. And we're definitely seeing more of those programs come out and be evaluated. As far as the other items, so inflationary pressures, I don't know that there's a day that goes by anymore where we're not hearing about inflation, trying to control inflation. We're seeing it with interest rates, as you see up on the screen as well. From everything we're hearing and seeing, we're going to be dealing with inflation for at least the next few months at levels that no one wants. So hopefully by the end of the 2022, maybe 2023, we're starting to see some of that come back down. But the reality is it's increasing wages, it's increasing supplies, we have supply chain issues already. So you add all that together, you really got to look for opportunities on how to address those things. Probably the most common thing we're seeing across all businesses at this point is just reevaluating contracts, so contracts with customers, making sure they contain escalation clauses. And honestly, I did hear one attorney, we listened to one presentation, they may have spent the last, I don't know, it may be they reevaluate contracts and language every couple of years. What's happening now, they're looking at it every couple months to make sure that language is protecting both the business and the consumer. It's not a time to try to have less margins to win work, especially when prices are going up the way they have been. It's not a good long-term strategy to try to go win work on low margins. So it's just an emphasis there where we're seeing just an increase in bids to make sure margins are where they need to be, especially considering all these increases. We're also seeing a lot more materials purchased up front. We're seeing contract language that allows for that, allows for the contractor to get paid up front. Also possibly consider financing, although the downside to that is interest rates are quickly on the rise. So you need the inventory, you need financing, costs a little bit more. I would say for those of us that have been around for a while, like I still see 5-6% interest, not too terrible. But again, it keeps going up and it definitely impacts your business when you're used to paying 1-2-3% interest. Last couple points, and I'll let Gary take over. Continue to invest in technology. I think even heading into the pandemic, getting through the pandemic, and continuing to grow after the pandemic, we saw the most success in those organizations that invested a lot in technology and continue to invest in technology. One of those, as we talk about fuel prices and things like that, absolutely affects this industry. Fleet management, so software, whether you use a software to manage your fleet, to manage your fuel consumption, it's amazing what software can do. So if you're not using some sort of fleet management software or vendor or other service provider to manage your fleet, fuel consumption, maintenance, definitely a big opportunity there. We've seen a lot of businesses have a lot of success with that level of data and information to help them manage through the fuel prices that are currently out there. So I know I went a little bit over, and I know Gary will touch on a few of these. So with that, I'm going to shift it over to Gary to give some observations from his perspective as well.
Thanks, Dan. Appreciate it being invited again here with McKonly Asbury folks. My name is Gary Rispoli. I'm a partner with Construction Risk Partners. We're a insurance, surety, and subcontractor default insurance brokerage that specializes in the construction industry. So we've got a pretty deep view and contact with the industry, and hopefully you'll benefit from some of that today. It's funny, I was going through some notes, and the first time I did this with the McKonly Asbury folks, it was February 25th, 2020. And boy, it's entitled, and the next slide, please. It's, I entitled this, 2021, kind of looking back, another year to remember. And it just, going from 2020 and that first presentation, not having any idea what we were in for. And then, last year, we kind of knew what was going on with the pandemic. And now I think some of the stuff that Dan's touched on, that I'll touch on, are things that we didn't really foresee in coming, but certainly we need to deal with it now. So in many respects, last year was quite a bounce back year for many contractors, and we view it as kind of the best of times and the worst of times. Many contractors enjoyed really solid revenue and profits, but that was not without a great deal of work and not without pain in terms of the supply chain disruption that all of our contractors saw and felt and had to manage through, and then add on the material price escalation issues that we've seen, and the continued labor shortages. Funny, I was reading an article, I was actually at a presentation, and they showed a clip, and it talked about the labor shortage and how it's getting worse, and the aging industry that we work in terms of construction. And then the presenter showed us the date of that article, and I think it was 1978. So this is not a new phenomenon, but it's getting worse, and it's not going away. And Dan touched on a little bit in terms of technology, and even in the construction space, and actually putting work in place. That's going to have to be a part of the solution. But all these things really drove some scheduling and cost pressures from the pandemic that have really created quite some uncertainty as we move forward here. Next slide, please. The current state of the market is pretty good. I mean, over 5% growth in non-residential, which is where I'll focus. Obviously, we all know the story relative to the producer price index and the material services inputs for non-construction, which is up over 17% year over year. And we're seeing that manifest itself in various risks, and some are very obvious, right? In terms of being able to estimate and put forth a proposal that you can abide by in terms of the cost. But it's also, we're seeing projects, some projects mothballed or delayed with the hopes that maybe prices will come down. And I think I agree with Dan. I don't think that we're going to see much of that until maybe hopefully later in 2022 or 2023. But I think trying to spin it in a good way, I think that the volatility that we've seen over the last 6 months, it's not quite as bad, and I can touch on that a little bit later. But throughout this, I think that the one thing that I'm most concerned about is the in terms of contractors' opportunities for new work, especially obviously on the private sector side, is the increasing interest rates and the ability to finance projects. Next slide, please.
No, it's hopefully I'm not stealing one of your slides, Gary, but I just listened to a presentation by Anand Bambasu, who most of us on this call probably know, economist, leads ABC. And for the first time in quite some time, like, part of his presentation wasn't necessarily geared towards construction, but at some point the consumer will push back on the price escalations and increases, which means cash at businesses will start to decline. So for the first time in probably months, if not a couple of years, I basically heard him say preservation of cash and making sure that you're focusing on your high performers, which I think applies to this arena as well, because obviously if you can't push the cost onto your customers, then it creates some difficulty, as you pointed out, with interest rates.
Yeah, and not to get too off track, but it's a great point, Dan. And I'll touch on this, and I touch on it every time I speak. And it's that go no go process, and you hit on it, and that is, so if we're entering in an environment where it starts to constrict, given the nature of what we're dealing with in terms of price escalation and the like, to go in with a lesser margin to acquire work is not a great strategy. It might be time to kind of right size your business, if that is in fact the kind of the environment we're going into. But this is just, I'm very visual, so hopefully this is beneficial to all of you out there. This just gives you a sense of how dramatic the price increases were in terms of the non-residential construction inputs. From that large jump from December of 2020 through to December 2021, it was over 19%. Just to give you a little sense, and these are a little more current numbers, like April, from December to April to 2020 to now, steel prices are up 113%. Same period, lumber is up 110%. Diesel, no surprise here, up 237%. So some real volatility and kind of the numbers behind. It's almost fascinating that the average increase is only 19.6%, given some of those major material inputs that are up so dramatically. Next slide, please. In forecasting 2022 and beyond, the good news is many contractors have healthy backlogs coming into this, and the next few slides will show that. We're going to need to deal with the continued issues with price escalation. In a perfect world, we deal with that through contract language, but it unfortunately is very, very unusual to be able to negotiate as a contractor price escalation clauses in contracts. So if you're a road contractor doing DOT work, you have your steel and you have your petroleum. But for many contractors that aren't in that space, it's almost wishful thinking, unfortunately, to be able to negotiate price escalation clauses. There remains, despite all this, there remains a good pipeline of new work. Going into the pandemic and even throughout, there's still a lot of money on the sidelines looking for investment places to invest their money. The challenge right now is, do we reach a point in terms of inflation and interest rates where those investments are no longer attractive and the money just stays on the sidelines? In terms of highway heavy civil contractors, we're still waiting and hopeful that the Infrastructure Investment and Jobs Act actually we start to see some benefit from that. I guess I'll real quick on my soapbox. There's been a lot of talk lately from a political standpoint about a federal gas tax holiday, which would, depending on how long that goes, 2 to 3 months, that would cost about $10 billion. That will not go into the Highway Trust Fund, and with the new Jobs Act, only $110 billion is dedicated to what we would traditionally look at as kind of roads, bridges, and highways. So that's a really meaningful, would be a meaningful amount of money. And then if states were to follow suit here, so the federal fuel tax is 18.4 cents a gallon. Here in Pennsylvania, it's 58 cents. So add that together. If the states decided to do the same thing, now all of a sudden you're really talking about a dramatic impact on the budget for road construction in the state. If they went through with both of those kind of short-term solutions, but I will not get political on that. So some of the leading indicators. The next page, please. This is the architect billing index, and it really, what it indicates is it's kind of a forward-looking view of are architects busy? Are they out designing new projects? And it's indicative of what's in the pipeline. So you can see that, and the index above 50 is positive. Anything below means we're shrinking. So through May, we're actually slightly positive, but you can see the large dip after the pandemic and the uncertainty that brought. Next slide, please. This is just in giving you some comparatives. We're kind of moving down in terms of billings. We were at 58 last month. We're 56.5 in April. These are always lagging, but it's still positive. There's still some optimism relative to the future and the pipeline of work. Next slide, please. This just breaks it down by region. All regions are positive. And kind of an Pennsylvania north is northeast, and then Delaware south is south. I don't know why they do that, but as you can see, the south has been relatively strong. The west had not been this strong. It's kind of surprising that it's uptick. They were actually the laggards if you track this index back a few months, but all positive here. Next slide, please. So this is pretty busy, but this is the Associated Builders and Contractors construction backlog indicator, and they poll their members, and it's indicative of how many months of backlog their members have. And so as you see here, in May, there's been a nice trend upward in terms of the amount of backlog contractors have. So again, there's a lot of positives going on despite all of the other challenges that we're facing. Next slide, please. And this is the ABC Construction Confidence Index, and it's again, it's on a 50, anything above 50 is positive on the top three slides, and again, are 3: sales, profit, and staffing. And in May of 2020, margins people are not overly optimistic, nor are they negative. They think margins will stay fairly consistent, but they're looking at staffing going up as well as sales going up. And I won't get into all the other details. A lot of this stuff, if you're interested, and even if you're not a member of ABC, you can go on the Associated Builders and Contractors website, and you'll have access to this information. Next slide, please. Here it is in graph form, and I think the thing that I point out in this slide is just how well the construction economy was doing, from the end of 2014 through to the pandemic, and then the large dip. And so we're not quite back to where we were, and I suspect that we probably won't be there until 2024. Next slide, please. So I think, given all that we've talked about, given the items that Dan touched on, it's really important to kind of to plan for this increased risk. I think that it's arguably, and I've actually polled a number of our contractors in conversation, and some of them have been in business quite a long time, and this has been some of the most challenging times they've ever faced. And I think it's really important to kind of revisit your business plan, and with the backdrop of the volatility that we're facing, and make sure that it's still relevant. You know, you need to deal with scheduling issues and labor constraints and the material price indexes. And I think that a part of that is, to the best of your ability, you really need to focus on the contractual risk you're willing to take, and tying that to that go, no go process. Because, you know, it's interesting, and I credit this to Travelers Surety, one of the largest sureties in the world. They have an extensive book, one of the either the largest or second largest, depending on the year in the world. And they did a study of all their contractor failures, and 58% of those failures were perfectly fine contractors that had one catastrophic job that put the contractor in failure. Think about that. So, and that's why I constantly touch on this go, no go process in terms of the things that you find acceptable and the things you don't find acceptable, and be pretty disciplined about it, because one material miss can put you out of business. And I think that the disciplined contractors are those contractors that are successful in any environment, even in the ones we're facing today. Next slide, please.
Gary, I mean, it's interesting you bring up that point, because I think we saw that with, and I think we're seeing a lot of M&A activity at this point. So you've seen a lot of mergers, a lot of acquisitions. We did see that a few years ago. Contractor was acquiring basically a book of business of open jobs and things like that. Just really wanted the employees few jobs. I mean, they went into due diligence and they said, how bad can it be? It's one of those kind of scenarios, and kind of backed off. Well, a couple of years later, I mean, it didn't far from put them out of business, but they found out it could be pretty bad. And so I think even through M&A activity and just being diligent through that process and making sure you're bringing in the right resources through that is all the same thing. It's really just manage your business. Is all the things I'm hearing from you.
It really is. It's and kind of establishing what the game plan is and sticking to it. You know, there's elements of the business you need to adjust and adapt and be flexible, but there's got to be some baseline for which you just will not, you won't bend. I think, and I've seen it time and time again where that leads to success or failure. Touching on the surety results for 2021. Record year, revenues for the first time, premiums over $7 billion, 17th consecutive year of profitability, an outstanding loss ratio. And because of all that profitability, no surprise, there are new surety entrants in the business looking to acquire customers, which in some regards, it's a good thing for contractors because the surety market remains fairly soft. As I say to some of our clients, it's a bad thing for well-heeled contractors that would like less competition, because these new entrants tend to kind of play on the fringes with contractors that may or may not warrant surety credit. So next slide, please. And this is the first quarter numbers for surety just came out, and more of the same. Slight uptick in loss ratio, but I'm not so sure it's a trend at this point. But hey, there are losses out there for sure. It's just that right now there hasn't been a frequency. Next slide. So what's on the minds of your surety company? And we're hearing this time and time again, and it relates back to the government subsidies, I'll call them, PPP loans, ERC or the employee retention credits. Sureties are really focused on operating profits. You know, when you strip away some of this other stuff, you know, is the firm profitable? And if not, that's not necessarily a bad thing. It's just that sureties are really doubling down on trying to distinguish what firms, you know, hit a bad stretch in after the pandemic and needed that boost from PPP loan or ERC, and what firms are just were really their lives were prolonged with the subsidies and the really systemic issues that still exist there. You know, and again, it all comes back to being able to mitigate risk. Construction is a risky business, and so today, there's still can you negotiate a contract that helps you, navigate supply chain, labor issues, price escalation. It's really a kind of a ground up holistic approach. Next slide, please. Some notable trends for contractors and sureties. The first one is if you think about it, it's common sense, right? The cost to correct a surety default at this point is up 2 to 3 times over historic averages because of inflation, because the contractors are fairly busy and it costs a lot more to fix a problem. And that's going to eventually, if it continues, affect the surety market in a negative way. And you touched on this, contractors seeing higher attrition rates among staff, and every contractor is dealing with that a little bit differently. Unfortunately, we're seeing contract terms going in the wrong direction. Back in the pandemic, everyone was interested in, do you have a force majeure clause, excusable delay language? Lately, we're reviewing contracts and there's no force majeure clause, it's gone. So, like I said, it's going in the wrong direction. It's going to take some discipline to push it back in the right direction to protect contractors. We are seeing a higher frequency of contract claims, and what I mean by that is disputes between contractors and owners, subcontractors, and contractors. And that's manifesting itself in unapproved change orders and larger underbillings and legal costs. Next slide, please. We saw it in Pennsylvania here a little bit. These mega projects, if you are a subscriber to like an ENR magazine, many of the national contractors saying they're no longer pursuing these large mega projects because when you need to fix a price guarantee on a design that's roughly 30% complete, that's a pretty difficult thing to do. There's probably a better way to do that and create more cost certainty with pricing with further developed design plans. M&A activity is definitely up. We're seeing private equity. We're seeing family office. We're also seeing an uptick in ESOP, which of those three I kind of like, and we've seen them be very successful. And anyway, the focus on building backlog to offset potential recession fears is real. It's just there's got to be some discipline. I go back to what Dan said. As long as there's margin in that backlog, if not, you're better off downsizing. Next slide. Hope is not a strategy, and this really rings true to me. You need to hit the potential challenges head on, and I think the best contractors are somewhat skeptical. You need to lead and manage it with a business plan. Be disciplined about your objectives and operate with that solid go no go matrix. Maintain open communication with your surety. Good news should be communicated quickly. Bad news should be communicated even quicker. And so perhaps surround yourself with professional experts that can help you and provide thoughtful and honest advice, like the folks at McKonly and Asbury and CRP. Next slide. With that, your third polling question. How do you expect your project backlog 12 months from now to compare to your current level of project backlog? Expect to exceed, expect to be on par, expect to be less, or not sure?
Yeah, no, and as we head up on 3 o'clock here, I mean, I think a lot of information in the presentation. I think we're still seeing a ton of opportunity with our clients, prospects, and basically just in construction in general. I think what we're starting to see is a little bit of a shift. I know we didn't get too much into like residential construction, but I'm hearing more about multifamily units and things like that and opportunities for that. And just with the cost of single family homes, maybe more opportunities for condominiums and apartments and things like that. So reality is there's still a need. It's just a matter of finding your niche and using that and developing that backlog. So it looks like those results are in, and I'm actually happy to see we expect it to be on, looks like most of the audience says expect to be on par with current project backlog, which is good to see. And I think that's kind of what we're seeing and what we expect to see, at least for the next 12 to 18 months.
Great.
So with that, I would like to thank everyone for joining us for today's webinar. If you have any further questions regarding today's presentation, definitely reach out to one of us. We'd be happy to assist. We like questions. We like talking about this stuff. It's things we like to do. I talk to Gary on a regular basis and ask what he's seeing out there. But a recording of today's presentation will be posted on our website and social media sites in a few days. And for those of you who requested CPE and answered the polling questions, those certificates will be sent out within the next 2 weeks. So thank you again for joining us and enjoy the rest of your day.